Hey, Dan Passarelli here. One of the best tools that we as chartists have at our disposal is support and resistance. Basically, connecting horizontal lines on a chart where when the price gets down to a level, it tends to bounce back higher and not go below that level, that support, and just the opposite for resistance, goes higher and can't bust above that level, that's resistance. But there's another measure for support and resistance that is really important, but just for a different reason, and that are long-term moving averages. Now, the two key long-term moving averages that I use are the 50-day moving average and the 200-day moving averages. Now, why are these important? Well, because there are a lot of traders at large funds who pick stocks and they try and beat the market. And in their charter, which is basically their set of rules, they're not allowed to own stocks that are below some of these long-term moving averages. And so what that does is when the stock is looking to move lower, a lot of times these traders will support it so that they don't have to sell the stock and instead buy more. Or if it does go decisively enough below it, by the end of the quarter, they're going to have to sell that stock, which can provide more downward pressure. So it just naturally ends up creating supply and demand that helps support, if you don't mind the, not really pun, but just double entendre, I don't know what it is, but that will support the idea of support or resistance, because that supply and demand is just naturally created because of the charter of the fund. So, hey, that is pretty useful information. It helps. You should keep an eye on that. Hope that helps. This is Dan Passarelli, Trade Smart.